Hello, everyone. Thank you for joining us today. We are covering some additional tax updates since we've last met with you over a month ago. We will be providing a recording of this webinar as well as resources from our previous webinars, possibly by end of day. So no need to take vigorous notes. All of this material will be available to you. I did want to recognize that many of you, as well as work, are standing in solidarity this week for justice and equity, and thank you. So we know this is a difficult time and frustrating time, and so hopefully we can shift gears a little bit to this and provide some solutions and clarity in other challenging areas of our business and our lives. Before we begin, do note that you will be on mute during the webinar. You can use the orange arrow to expand and collapse your control panel. Please type in your questions as they come. We'll do our best to answer those live, and then we'll save some time for the end for any at the end for any additional questions. If you're not familiar with Work, we are the leading provider of payroll, HR, and workforce management solutions for the cannabis industry. We serve anywhere from a small market enterprise and serve all businesses in all 33 states. Today we are welcoming Martin Howell, Works SVP, Senior Vice President of Operations, as well as Nick Richards, a partner at Green Spoon Martyr, and then Jim Marty, the CEO of Bridge West. Today's agenda will be giving a quick update on a 280E Harborside case from Nick Richards, as well as diving into some of the COVID-related issues, including a Paycheck Protection Program update, a current status of federal and state tax agencies, covering the tax aid summaries, which we've covered previously, and how those affect work clients specifically, and then updates to the Form 941 draft. We'll dive into that pretty in depth, and then again we'll save time for questions at the end. So I'm going to hand it over to our presenters today. We'll start with Nick. I know you're having some video issues, but hopefully we can still hear you.
Thanks, Heather. And thanks, Work, for the opportunity to talk to your folks. You know, I'm not gonna, my webcam's not working, and probably because, you know, I've got my shirt off or something, I don't know, but okay, so a little update on what's going on in the world of 280E. On what was the date? So on the 26th of last month, we filed our opening brief in the Harborside appeal case. It's out there and you can get a copy of it. There was an article in MJ Biz, and there's a link in that article to the actual brief if you want to download it. It's very interesting. It's very good reading. If you understand that case in the tax court, the taxpayers argued that they were not subject to 280E because their activities did not consist of trafficking in a controlled substance. On brief or on appeal, we are arguing that Section 280E is unconstitutional under the 16th Amendment because it results in a tax on more than income. And we are also arguing that the different treatment of the cannabis industry under Section 471A and the distinction between cost of goods sold and non-cost of goods sold, and the use of a code section called 263 Cap A is also unconstitutional based upon that 16th Amendment. The 16th Amendment essentially says that the U.S. Congress, and it is the 16th Amendment to the U.S. Constitution, so it's the highest law in the land, that the U.S. Congress has a right to tax, quote, income. And previous to the 16th Amendment, the only tax that the U.S. government could impose was an apportioned tax, meaning it had to be equally apportioned between the states. So an income tax wouldn't work because it's based upon individual income, not state population. And so because Section 280E is not a, quote, tax on income, and let me go back to that, but because Section 280E is not a tax on income, it therefore has to be apportioned because it's not then authorized under the 16th Amendment, and because it's not apportioned, it's unconstitutional. And the basis on the position that it's not a tax on income is because as we in the industry know full well, 280E creates phantom income. And phantom income for anybody who has received it is not real income. And under a famous case called Eisner v. McComber, the U.S. Supreme Court held that income was the gain from capital, labor, or both. And we are going back to that definition on income and challenging 280E on the basis of that definition directly. Previous attempts at that type of argument have run up against a concept called legislative grace, and the lower courts have basically said, we don't need to talk about that because deductions are a matter of legislative grace, so we don't really have to get down to the nitty-gritty on what really income is. But many of us in the industry have felt that that was a problem for Section 280E. And Jim and I have been talking about this a lot, and certainly we believe that it is a problem when the tax is more than the income. We are arguing that that the code section is unconstitutional as written because it applies to all deductions and credits. And that position was also set forth by a dissenting opinion in the Northern California small business assistance case. So that is the position that we're setting forth in the Harborside appeal. And I want to let Jim talk for a minute on this as well. I think, Jim, it's interesting. The brief goes directly into discussing this concept of legislative grace, and it makes the argument basically that first off, this idea came from dicta in a case, and it's become this supercharged term where it originally was not intended to be so by the Supreme Court. But nevertheless, that legislative grace is limited to the boundaries of the 16th Amendment limitations on tax on income. And so to the extent that it is a tax on more than income, the legislative grace doesn't apply. Jim, I think that is a really interesting position and a really interesting discussion regarding our 471C issue that we are dealing with right now, because 471C, of course, says that so long as you do things right, that your method shall not fail to accurately reflect income. And so here in this brief, we have a very detailed discussion on the concept of income under the Internal Revenue Code, and also on legislative grace, which is the other piece of 471C that we've been talking about a lot as well. So I think it's quite exciting.
Well, those are all very good points and very well presented, Nick. As the nuts and bolts accountant for many cannabis companies, we can see situations where the tax is actually higher than the income. So the taxpayer is in an excess of 100% tax bracket. I got to testify to that in tax court very early on in Colorado in the Feinberg case. And the judge was very surprised to find out that 280 could result in a situation where the taxes were greater than the income. And without taking up a lot of time, very simple explanation is say that you happen to have a loss because you're in an early year. So in a year you have loss, you have to pay taxes. Clearly you're in excess of 100% tax bracket in that case.
Yeah, and Jim, you and I have also discussed that we think that failure to pay penalties are inappropriate when based on phantom income, which 280E creates. It's a similar sort of argument, but it falls then under the 8th Amendment as an unreasonable penalty. You can't have an income tax penalty on a tax that isn't income. I'm happy to say that I've gotten an offer to concede 50% of a failure to pay penalty based upon that argument from IRS appeals. I just got that offer today on a case that I have before them. So, I think there is some merit to the limitations argument under the 16th Amendment of Section 280E.
Yeah, again, very good points. And yeah, the failure to pay penalty really equates to a interest expense in a lot of ways. So whatever luck you're having in getting that waived is very beneficial to the cannabis industry as a whole.
Yeah, I think that's true. I think that's about all I want to say. I would suggest that everyone in the industry be looking at both the Harborside briefs, and there's been 2 amicus briefs filed as well. For those of you that don't know what that means, that's a sort of a friend of the court brief where outside parties who aren't Harborside and aren't the government file briefs because they believe the issues are sufficiently important that an outside voice should be heard as well. So that has happened as well. It's going to be a while. One of the things that could be worth thinking about for those of you out there that are involved in preparing and filing tax returns is a protective claim for refund in the case of if you've had a prior position that was challenged by the IRS and certain expenses were disallowed that probably will turn out to be allowable under the appeal. And I'm not saying we're going to win completely on the constitutional issue, but I do believe there are some of the specific expenses that we'll be able to establish. So you might, those of you out there that have past liabilities might want to look at that and see if there is a opportunity to protect your hand here.
Right. And the short version of a protective claim in my language would be that it tolls the statute of limitations, but just for that 1 or maybe 2 issues.
Yep.
So that way the 3 years goes by, now you're stuck. Well, and if you file the protective claim, the 3 years doesn't matter. You can go back in. I'll let Nick clarify, but virtually any time if you file the protective claim.
Yeah. Yeah, a protective claim. So when you file a tax return, you have 3 years to amend that tax return. And so if the law changes after you file a return, or it looks like it may change after you file a return, you can file what's called a protective claim within that 3-year statute and get another 3 years basically on that claim because you've made that 3-year filing, and now you get another 3 years on that amended return that you've put before the IRS. So it's a way to get more time on an uncertain position. And you know, Jim, I think we'll be talking under 471C about a different kind of protective claim, but a similar concept to file a tax return and ask the IRS to sort of hold it pending the outcome of certain events that haven't yet occurred.
Right.
Great, thanks, Nick. We got a comment actually cheering you on, saying good luck with the appeal. It's very exciting. Do you want to have an opportunity for you to give an update on the PPP as well?
Thank you, Heather. So, you know, I was hoping to give a better update on the PPP. Last week, I had a client that let me know that they had a bank that was willing to submit a loan application under the PPP on them, and they're a vertically integrated dispensary and cultivation operation, and it looked really good. They were willing to do it, and they were moving in that direction. And there was some news in the industry last week about the fact that there was a lot of money left in the PPP. I think it's something like $90 billion, 90-some billion dollars right now, and that the industry should start applying for that. Unfortunately, my client that thought they were going to get a bank to help them apply, the bank has sort of chickened out on it, I think is the right word, or taken the position that it's not allowed is probably the more generous word. And in discussions with that bank and pushing back on that decision, we are being told that the bank is drawing a distinction between direct marijuana companies and indirect companies that benefit from other marijuana companies, and it appears to be that companies like law firms and accounting firms and providers are being allowed the PPP, while direct marijuana companies, unfortunately, are not.
And yeah, that's been our experience too, is we haven't seen any banks willing to go to bat for a cannabis company, but the indirect companies are getting their PPP loans.
All right, why don't I jump in here? Thanks, thanks Jim, and thanks Nick for those updates. We have heard from our tax agency partners, the IRS particularly, that they are open for business again. They had suspended a lot of their call center activity, and we are experiencing lower hold times, and our tax practitioner hotline is now open for business. So we're moving forward with some of our tax inquiries that we have. And Nick, I think you had some experience also on the collections of debts.
Yeah, when the IRS announced the extension on filing and payment for the 2019 taxes, and they extended those out to July 15th, they also informally suspended collection operations. And in speaking to an IRS collection manager, I was told that all collection officials are being advised to exercise extreme caution in using any of their collection powers. So that would be liens and levies. And so I have not seen any exercise of those powers over the last, let's say, 2 months or so. I will say this: I think that that the computer is still working, and notices of federal tax lien, I think, are going to start getting filed automatically again. I had a, you always know when those notices are filed, because some of the offer mills, as I call them out there, those advertisements that you hear on TV and the news about settling your taxes for pennies on the dollar, they have some ability to get notices of federal tax lien before they are made public record. And so clients that get notices of federal tax lien filed start getting phone calls from those guys. And I had that happen to a client last week. And so I think that the machine is rolling again, and notices of federal tax liens the computer is filing them. I also know that the IRS officials that deal with actual tax cases, so that would be generally appeals, IRS collection officers, and revenue agents, they're starting to reach out to me again. They're starting to wake up. I've got a couple appeals cases where they've given me some deadlines and some things like that. So they're trying to get back to work for sure. They understand that we all were shut down for a little while, and so they're given ample time to kind of get back up to speed. But I think everyone should be ready for that to start happening again. Certainly, I think people will get contacted this month, and there will be deadlines next month.
All right, that sounds great. All right, let me jump into some more tax-oriented, specific to payroll tax-oriented items. We have been giving you updates on all of these topics as we've gone along, and I'm pleased to report that all 5 of the tax aids that are listed, and they're listed by the FFCRA, the Families First Coronavirus Response Act, as well as the CARES Act, have now been programatized within our own payroll system. So all of those of you who are our clients listening on the call, that's great news. Many of you have already signed up for taking advantage of all these benefits, and now we have system methods to help you take advantage of each of them. The last 2 that we had are listed here as tax aid number 2 and tax aid number 5, and those were newly programatized this last week, and we've completed our testing, and we're ready to roll with those. So we're excited about that. The other thing that has happened is a new a draft of the 941 tax return has been released by the IRS in the last couple of weeks, and we'll review some of the details of the new 941 here in a moment. Okay, let's go to the next one. One of the details that the IRS published within the last week is clarification on tax aids 2 and 5 allow for an health insurance expense credit, and they clarified what is involved, what you can include as you are examining what credit to take. The health insurance expense credit includes all of the out-of-pocket expenses by the employer, as well as the pre-tax contributions by the employee. But in yellow, you see that it does not include the amounts that the employee paid for with after-tax contributions. So if your client's not taking advantage of the Section 125 pre-tax benefits, then the after-tax contributions of the employee are not going to be part of the credit. So I think this is the IRS's and the government's way of encouraging participation with the pre-tax Section 125 on the part of the employer. So it's a nice clarification that the IRS has put out. Let's go to the next slide. So the 941, this is a little bit too small to read. I've blown up some of the details on future slides, but this is a snapshot of the new draft. We have a full 3-page 941 now, where it was 2 pages previously. They have not done anything with the Schedule B, which itemizes per pay period liabilities. Not as of yet. We don't anticipate there will be a change to the Schedule B, that will continue as is. They've also added an additional worksheet for the calculation of a lot of the CARES Act and FFCRA benefits. So this is page 1 of the 941. Let's go to the next one. This is page 2, and then we go on to the next one is page 3. And then the next page is the new worksheet that is part of the instructions that have been newly released as a draft for this 941. Now, the 941 is going to be made available, the final version, they're promising by June 27th, just 3 days before the end of the quarter. Hopefully not hopefully, but that will give those of us who are the payroll processors time to get our final versions of the 941s in place so that we can file them on behalf of their clients, on all of us on behalf of our clients. Let's go to the next slide, which gives a little more a zoomed in view of some of the changes. This is off of page 1 of the new 941. A couple of additional lines 5A have been added, a 5A sub 1 and a 5A sub 2, so that the qualified sick leave wages and the qualified family leave wages can be reported that are new under the FFCRA. You may recall tax aid number 1 allows for the deferrals, tax aid number 2 allows for employee retention credit, which will be on a future slide, but tax aids number 3, 4, and 5 all relate to the new sick leave types. This is where the employer portion of Social Security is now calculated in preparation for that to be made exempt from and subtracted from what would normally have been the full tax liability on the 941 for the quarter. So those are a couple new lines. Let's go to the next page. Rows 11B and 11C from page 2 have also been, there are new lines that have been added, allowing for the calculation of the non-refundable portion of the credit for the qualified sick and family leave, as well as the employee retention credit. This is the IRS making it so that there isn't double dipping on the credits. You can't take the same wages that are paid out, whether under sick leave or under an employee retention credit, and you can't double use a credit twice for those same wages. And so the IRS has a calculation from the worksheet that's part of the instructions that prevents double dipping on the credit itself against the same wages. As we move to row 11D, that's the sum total of those non-refundable credits. Then they've added row 13B through 13G. Actually, all of the rows on this part 1 are new, except for number 14. 13B talks about the deferred amount of the employer's share of Social Security tax. As you may recall, under tax aid number 1, the IRS, the government, is allowing for the deferral of the employer portion of Social Security payments until 2021 and 2022, and this is the place where you summarize that. And then 13C is itemizing the refundable portion of the credit for qualified sick and family leave wages and the employee retention credit. So this is where the wages are actually doing a direct dollar for dollar reduction of the federal tax deposit liability for the quarter. This is where the largest credits, these are the best lines and where the greatest benefits are for our clients. I'll pause for a moment and just make the statement. I think all of us on this call it's worth re-emphasizing. Our purpose here really is to assist all of our associated employers in taking advantage of every credit, every reduction, every deferral, and every benefit that's available to them to assist in the financial operation of the business. And where eligible, we make it as our mission to try to help you take advantage of all of these credits and deferrals and refunds that are available. And so the 941 now is going to capture that in full, and it's our job to help facilitate that for you.
And Martin?
So yes, please jump in, Jim.
Just to make sure it's clear that these benefits are available to the cannabis industry as opposed to the PPP loans.
It's absolutely true. And all tax aids 1 through 5 are fully available to the cannabis industry. We've run into no barriers in that regard. So that's great. And so this will not have any, this will not be, this form, the 941, as we complete it for our cannabis clients, will not look any different than it would for a non-cannabis client. So there's no exceptions and no considerations for any of these lines as we complete it. So going to 13E is just, yes, please.
Sorry to interrupt. We did have a question come in asking if there is a chance that deferrals won't need to be paid back.
We've seen no evidence of that. I think the deferral itself is tax aid number 1, and that is simply the Social Security employer portion, the 6.2% that employers pay on Social Security. They have pushed that out till 2021 and 2022, but I have read nothing on the IRS publications and nothing regarding all of the CARES Act and FFCRA that have been passed that indicate that will be forgiven altogether. I think right now it looks like it's just going to be a deferral. Jim, in the accounting world, are you hearing anything differently?
No, nothing different other than to make the comment that, in politics, that's a long ways away, and a lot could happen in that year or two regarding that, whether those deferrals will need to be paid back or not.
Yeah, that sounds great. We also have a question, are we saying that we can get a dollar for dollar credit for anyone who's been furloughed and is on company health insurance? And so the answer to that is, in order to receive the health insurance credit, it needs to be associated with the wages that qualify for the employee retention credit. So if you're not paying wages out, then I don't see that you would be able to attach a health insurance exemption to wages that aren't being paid out, which would be the case under a furlough scenario. Likewise, if you aren't paying wages out under the sick and family leave types, then the health insurance expenses associated with those 2 leave types would also not be subject to this exemption or the credit that we're seeing on the 941. So hopefully that answers your question. And I think we've now addressed every question that's on the board so far. Great. So hopefully, if you have any clarifying questions, please don't hesitate to repost. Let's still go back to the previous section. Let me finish up with that one, Heather. Thank you. So there's also note line 13F. We're running into situations where there are so many credits and deferrals available to our clients that it's wiping out all of their federal tax deposit due for a particular pay period and more, in which case our clients will have available to them to complete a Form 7200, and they can complete that as they go along to request the additional credited funds back in a refund from the IRS. So the IRS recognizes that some of these credits will be large for companies and will be a greater dollar amount than the actual per pay period federal tax deposit. So this in row 13F, this is where our clients will accumulate all of the Form 7200 amounts that are requested from the IRS, and we report them on the 941 to make sure that they're not also double dipped. And then, of course, the summary line 13G, where it's all pulled together before and the total tax for the entire quarter is calculated. This is a typical line that we've had a little bit modified now on the new 941. All right, let's jump to the next. This is a summary section. Part 3 has been greatly expanded on the new 941. By the way, the 941 has not been changed substantively for many, many years. So in the accounting world, it's turning a lot of our payroll systems upside down to get this all programmed and add the many, many new lines that are being added. So it's creating a stir, and we're scrambling to make sure that we get it all in place. And so far, it looks excellent on the programming side. Rows 19 and 20 are associated with the health plan expenses allocable to the qualified sick leave and the qualified family leave under the FFCRA. And this is where we report those total amounts for the quarter to the IRS. And then likewise, row 21 under the CARES Act, section 2301, that is where the employee retention credit is allowed. And keep in mind, the rules for the employee retention credit are different for employers with accumulation of less than 100 employees. They're allowed to apply the credit. If they're eligible in general, they're allowed to apply the credit to all wages paid out, whereas employers with over 100 employees need to only apply it to wages paid to employees who are actually not performing work, but who are continuing to receive a paycheck. So the IRS has made that distinction. There's more clarification on that with the FAQs that the IRS has published on the retention credit. So those 19, 20, and 21 are significant credits for many of our employers. Then row 22, once again, asks for the reporting of health plan expenses allocable to the wages associated in row 21. And likewise, that rows 19 and 20 have to do with the health plan expenses as well, associated with those credits. And all of this, again, is going to roll up into the final calculation of what the 941 liability is going to be for the quarter, hopefully much reduced for many of our clients. In rows 24 and 25, rows 24 is reporting the qualified wages that are carryover wages from first quarter in that period when the program was in place, that the IRS instructed that businesses not report this on their first quarter 941. This is a section where they've carried it forward to the second quarter 941. This row 24 specifically to the employee retention credit, and row 25 the associated health plan expenses attributable to those employee retention credits. All right, so it's a lot of extra lines, but they have covered every one of the 5 tax aids that we've been reporting to you on our previous webinars. And we're excited to help all of our clients and employers take advantage of these, every one of these benefits. All right, let's jump to the next. We do have a couple of questions. If a hemp company has a PPP loan, can they utilize these credits? And so I'm wondering if if somebody on the panel wants to tackle that. So the PPP loan is not a disqualifier. I will say it's not a disqualifier for the employee retention credit unless the loan has been forgiven, and then that becomes a disqualifier for the full employee retention credit. That's my knowledge of that, but I don't know if the rest of the group wants to pipe in. If PPP loans are out there, I think all of these credits are available other than that one single exception. Does
Martin,
the group know any differently? Yes, please.
Sure. But my understanding is the same as yours. I had assumed that it applied to the other types of credits as well, but I don't know for certain on that.
Yeah, so I do know that it is not a showstopper for the sick leave and the family leave for certain, and that's tax aids 3, 4, and 5. And tax aid 2 is the qualifier if the loan has been forgiven, and then you cannot take the employee retention credit. And then tax aid number 1 is just simply the deferral of all Social Security payments, the employer portion of Social Security payments. And I think our documentation tells us that that's available to all employers regardless of their PPP status. So I think together it sounds like we agree that's not a disqualifier. So it's great news for everybody.
Yeah, I agree with that.
Okay, great. And we have one additional question. What types of employees are not doing work but are receiving a paycheck? That's up to an individual employer. We know that there are scenarios out there where employers wanted to keep their employees receiving a paycheck, but they were for various reasons, including COVID-19, being subject to COVID-19, they weren't able to perform any labor at all. And so for employers over 100 employees, that is how the employee retention credit is applied, and you can only apply it to those wages where work was not being performed, which for some employers that's very restrictive. But yeah, it was kind of an interesting clause that the IRS put in there in the CARES Act. But you can read more about that under the retention credit. CARES Act Section 2301 gives more details about exactly who's eligible for that. So that's a great question. Kind of an unusual clause for the IRS to put that in, but hopefully encouraging employers in some cases to continue to pay employees even when they weren't performing the full labor of their jobs. I think that's the end of our kind of the tax and the tax benefits surrounding the CARES Act, the FFCRA, and the 941. And we've answered a good number of the questions. But Jim or Nick, were there any other comments or questions that you want to throw in before we go to any more Q&A?
Martin, this is Nick. Yeah, I just wanted to remind everyone that the 471C option for any existing business has to be done on the 2019 tax return. That would be a timely filed change of accounting method, and it's automatically accepted if it's on a timely filed return, and those returns are due July 15th. And so I just wanted to get that in front of everybody on their radar. If you haven't spoken to your tax professional about the 471C position, then you should. As we said earlier, it's an uncertain tax position, but it is sufficiently well supported by the Internal Revenue Code that everyone in this industry needs to make an educated decision on whether or not they want to make a 471C election. I'm calling it an election. It's really a change of accounting method on their 2019 tax returns. The reason I say that is because that accounting method right now is provided for under the Internal Revenue Code, and it's automatic, meaning you get to disclose exactly what you're doing under 471C to the IRS, and they can't say no. It's automatically accepted, and that could change in the future. And so there's a window that's open now potentially, and we all need to get smart around that window and make an educated decision on it in the next month or so. And
to add to that, if you have filed for an extension for a corporate or partnership tax return, then your due date will be either September 15th or October 15th. Correct, Nick?
Yeah, I believe that's correct.
So if you've been put on extension, you have a little more time than July 15th. And the other comment I would make, if 2019 is your initial tax return, that is just an absolutely perfect time to elect into 471C.
Yeah, that's so true, Jim, because you would be establishing that accounting method from the beginning. Yes. Of your operations, and there wouldn't be a change of accounting method required under that process. And I'll say it again, I think a lot of what's in the Harborside brief supports the arguments for the 471C position in a very intriguing way. So I would recommend that reading for our viewers out there.
Yep, I agree with what you're saying.
And Martin, let me say one other thing.
You bet.
Jim and I have been contemplating the use of what's called a protective claim, and it came up a little earlier on the conference. That's a process to put out a just in case tax return. And so I believe that the smart way forward, and you should talk with your professionals about this, is to go ahead and take the 471C position and then file a protective claim that is your regular 280E position to kind of give you a defensive position if for some reason the 471C option doesn't work. And that's a fairly difficult process that you need to talk to your professionals about.
Right, because another benefit of doing what you just said, Nick, is that can help you get penalties waived in the future should the IRS go and accept that fallback tax return.
That's right.
All right, that sounds great. All right, I think that concludes everything that we have on the content side, and we have completed with the questions. So Heather, any other details you'd like to throw out for the call?
No, thank you all for joining us. For those of you that are our clients, please be on the lookout for additional communications about the tax aids that Martin covered in the next couple of days. And then we will be hosting future webinars, so keep an eye out for invitations to those. And again, we appreciate you taking the time, and stay tuned for the recording and PowerPoint presentation within the next 24 hours. Thank you, Nick, Jim, and Martin, for taking the time today. As always, we really appreciate your partnership.
Thank you.
Thank you.
Take care, everyone.
All right, bye-bye.
Black Lives Matter.
Yes, of course.